Hey guys, Mike here. So normally don't do Friday videos a lot of times, but boy, today, whoo! You know, we had stuff happen, so I said, well, I got to at least put a video out there to keep everyone updated. If you're wondering why your portfolio looks like crap, then this is pretty much why. It's because Jerome Powell spoke this morning and did something I honestly will admit I didn't think he'd do. He didn't say my line with as much aggression as I like, but for a man with hardly any pulse and a politician, he came close enough for me to say, good job, Jerome Powell. You know, that's what needed to be said. And, you know, you look at the markets, I mean, it was bad, man. I mean, it just kept going down and down and down. And people thought, well, there's got to be a bottom here somewhere. Oh, no, it was not. I mean, look at the VIX, for God's sakes.
All right, all right, all right. Yeah.
And I'm pretty sure that was Jerome Powell's reaction after he saw the market dump. Because understand, the reason why he came out like that, and nobody has heard Jerome Powell speak like that before. And I'll tell you, and we're going to go through what he said. I cut the whole thing down in some clips for you, and you got to understand what triggered this. Those key words, all right? And I'm pretty sure once he saw the markets go down, he's like, yeah, I told you not to be running back up. Because understand, when the stock market ran up like it did, like it was, you know, 2020 all over again, meme stocks, crypto, you name it, ARK Invest stocks flying, doubling, going up 100%. He's like, whoa, wait a minute. What's happening here? You know, obviously we have not been direct enough. I don't know what these people are, you know, getting there. We're going to pivot in March of 2023. What are they talking about? Start cutting rates? Like, what is going on here? And, you know, you can see this, just to really quick talk about this, the SPX, what I talk about, that 100-day, you know, there it is. And, you know, in the 30-minute, we closed below it. And so you can see us break through that. So Monday will be a very interesting day to see where this momentum continues or if it stabilizes or not. So we will be hitting support levels. There are gaps to be filled below. There are still gaps to be filled above. And so it depends on where market makers wants to take us. But the one place we shouldn't go is to all-time new highs anytime soon. And by the way, if you get anything out of this, please hit that like and subscribe button for me. I really appreciate it. Because if that happens, all it does, it makes everybody's portfolios, all portfolios look great short term. But all it does is force the Fed's hand. They will have to be more aggressive for a longer period of time, okay? And you're going to see what I'm talking about. I'm going to touch base on that in just a minute. But this right here is, I can tell you what the body language was. If I'm you know, basically choreographing or just showing you exactly what the hedge funds, I'm sure they stopped and listened to this today, and the guys were sitting there and they were probably slumped down in the chair and stuff like this right here, you know, and listening to Jerome Powell speak, and they're looking at the screen, and all of a sudden he got on there and said this right here.
Today, my remarks will be shorter, my focus narrower, and my message more direct.
And they're like, what did he say, Bob? Did he say more direct? Wait a minute, I ain't never heard him speak like this before. He was like, he's serious. Wait a minute. And they set up real quick.
Reducing inflation is likely to require a sustained period of below-trend growth. Moreover, there will very likely be some softening of labor market conditions. While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. These are the unfortunate costs of reducing inflation. But a failure to restore price stability would mean far greater pain.
Wait a minute, did he say pain? What? Softening labor markets? What's going on here? Holy, sell! And I'm telling you, those algorithms kicked in as soon as they heard that phrase. I'll tell you, heard people talk about that. Oh my God, he say pain? What's happening? You know, and it started ticking down. And then he got into his next little bit, and this is what really sent the markets down.
The labor market is particularly strong, but it is clearly out of balance, with demand for workers substantially exceeding the supply of available workers. Inflation is running well above 2%, and high inflation has continued to spread through the economy. While the lower inflation readings for July are certainly welcome, a single month's improvement falls far short of what the committee will need to see before we are confident that inflation is moving down. So, we are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. At our most recent meeting in July, the FOMC raised the target range for the federal funds rate to 2.25% to 2.5%, which is in the Summary of Economic Projections range of estimates of where the federal funds rate is projected to settle in the longer run. In current circumstances, with inflation running far above 2% and the labor market extremely tight, Estimates of longer run neutral are not a place to pause or stop.
I.e., money is not going to be cheap anymore. No more free money. Not going to happen. We're not going to prop up the mortgage industry anymore. We're not going to keep buying bonds. You know, like it's going out of style. You guys are going to have to take up and pick up on that end because we're not going to do it right now because we can't. At least that's what he's saying.
Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy. Committee participants' most recent individual projections from the June SEP showed the median federal funds rate running slightly below 4% through the end of 2023. Participants will update their projections at the September meeting. It's also true, in my view, that the current high inflation in the United States is the product of strong demand and constrained supply, and that the Fed's tools work principally on aggregate demand. None of this diminishes the Federal Reserve's responsibility to carry out our assigned task of achieving price stability. There is clearly a job to do in moderating demand to better align with supply. We are committed to doing that job.
And what he's trying to say in plain English is you have to lose your jobs. You have to lose your jobs, therefore it takes away your buying power. You have to not only lose your jobs, we also have to take away your ability to tell employers you need higher wages, okay? Because you can negotiate more if there's less people out there that are out there to take the job. If you're the only one for the job, you can say, oh, well, I'm not taking that. I'll take this over here, though. And they look behind you, and there's nobody behind you. So they go, okay, guess that's what we'll do, right? And what does that do? Less money in the system, i.e. less money we have to spend. That brings down demand. That helps supply chains get back online. To me, it's like another. I gave you the damn version example for those who are new to the channel. Though you probably didn't hear that. So let me give you another example. This is what happens to supply chains, and it's still happening. One thing we love to do is buy crap we don't need. Let's be real about it. Really, really do. One, because it's just convenient. Two, because we're trained as little children to do that, right? And if you don't believe that, just take the challenge. Go down with a piece of paper this month. Go down to your credit card statements because nobody pays cash for anything, and write down all the things you absolutely must have, right? Your mortgage, your rent, your power, groceries, blah, blah, blah. And then look at your credit card statements and go down the crap you could live without. I'll guarantee you the crap you live without is going to far outweigh the necessities, okay? That's just the way it is. That's how our economy continues to produce high GDP and all these companies that have record profits, all this stuff, right? And so, the funny thing is we could actually fix inflation ourselves if, people would just say, you know what? If I don't need it, I'm not going to buy it for a couple months. Oh, imagine that. It would put a shock in the system. But guess what? Demand would go from here to here on most everything, right? And so, but understand the other thing is look what's happening. I was going to give you an example. Imagine there's only one store in every city, right? I'll say you own the store and you shut it down for 6 months, i.e. we shut the world down, right? And then all of a sudden, you have 10 items in the store from 10 different suppliers, and they're in high demand, right? Because nobody's been able to buy them for a long time. And you say, we're going to open up on January 1st. And all of a sudden, January 1st rolls around. What's happening? People outside the door waiting in the thousands. You say, we only let 200 people in at a time, and you let that first wave in. What's going to happen? They're going to tear the store apart, taking everything. Boom. All of a sudden, the second wave comes in. You look back, and you got nothing left in the store. And you say, hold on a second. You call your supplier. Hey, Jimmy, I need all these items, blah, blah, blah. And he goes, what? We used to having orders this big, right? Because, the stores are usually filled. But you're telling me the whole store is empty, so now we have orders this big? Yep. Second wave comes in. He gets it to you. Boom. Hit again. You got to call Jimmy up, and he goes, dang, I can't do it. I don't have enough employees to do it. And these waves, I'm getting this from every store out there. And it's just what they call waving us in the restaurant industry, where you're just sitting there. And I used to be in the restaurant industry many years ago, and we used to wave the kitchen, and all the tickets come in because all the freaking hostess would set the people all at once instead of staggering it out. And so, that's what's happening. It still happens, right? And then, of course, why did it really happen? Because companies like Walmart and Target were ordering double, triple ordering, and then they ordered the wrong stuff. And so now they're stuck with all this inventory. And so it's a hot mess. Yet we're still running up the credit cards, right? Record levels right now. And so what has to happen? What do you see happening? That's the funny thing is you want to know, and he talked about what's he going to see. They're going to slow the economy. That's the goal, is to slow the economy. It can't be any more plain than what he just said. And they're not lowering interest rates supposedly until, if something bad happens, trust me, they'll make the pivot. They'll have to make the pivot. There's no ifs, ands, or buts about it. But they don't want to say that, because if they say it, all of a sudden it gives the market a bone to and run it up. And if yields start dropping again and mortgage rates start dropping again, all of a sudden we get out there and we're spending even more because it's easier to get it now and it's cheaper money. That's the total opposite of what they need to happen right now. Remember, in our lifetime, most of our lifetimes, we hadn't faced inflation like this. But I will say this, not one time in history, I think this is the 10th time the inflation has gone over 5%, have we ever avoided recession. Never happened. And we've never actually gotten it below 5% without the Fed's funds rate being above, I believe, what core inflation actually would be. Now, which we could actually do, because core inflation is like 6.2%, I believe, or something like that. So if they get the Fed funds rate, let's say 4%, meanwhile core inflation is coming down, you can see that could happen. I mean, headline, they don't care about it, and that would never happen because it's way too high. But at least core, right? And that's the housing, that kind of stuff. And so that could happen. But, if you want to know, and I showed you this chart, and I'll put the video at the end if you haven't seen it, where we're at in the economic cycle, ask yourself this. Let's keep it very simple. Forget about charts and anything else. All you got to do, I have a neighbor, gave me a ride somewhere the other day, and he's a friend, and, keeping his business to himself, but he did say, he's a recruiter, and he got laid off the other day. And he works for one of the big FANG companies. I won't say which one, but just one of the big FANG companies. He said they let go of all the contract recruiters, right? What did Apple do with their recruiters, right? What did all these big companies you don't get to be as big as they are because you're stupidly ran, okay? They're well-run companies. That's why they got to be where they're at, okay? And they're laying off these recruiters, which what do recruiters do? They find you the talent you need to expand your company, okay? You even got some of them going as far as announcing they won't even do interns right now. Interns either work for free. I was an intern way back in college. I didn't get paid. Or you get very little pay. They're not even doing that, right? So then they're doing hiring freezes. Some are laying off. What does that tell you? Are we in the expansion phase or a contraction phase? What do you think here, right? If you listen to the earnings calls, you'll see margins are shrinking, right? Now, here's the tough part. Yeah, we're definitely in a contraction phase. The problem is, what kind of contraction? Because, the problem is we got so much demand pulled forward in 2020, 2021. Are we just trying to get back to 2000, like the end of 2019 levels and kind of pick up from there? Because that wouldn't be a huge contraction, believe it or not, at all. But we just had all of this going on here. We pulled all this forward. All this demand came forward, right? And now people just don't need all this stuff, supposedly. I don't know. Or can't get it, one of the two. And so that's really the conundrum we're in. Like, how much contraction are we going to get here? Because you're definitely in contraction because you don't lay off your recruiters if you're trying to expand. That's not the way it works, right? And here's the other thing. Here's another really red flag to me. Companies, instead of spending money and taking on debt to buy extra warehouses or equipment or hire people and train them, they're doing record stock buybacks. Or they're taking out debt to have the money to buy back the stock. What does that tell you they think is going to happen to their stock? Because they're not going to buy it way up here. They think the stock's going down, right? And so how do you stabilize your stock and how do you attract investors? You spend billions of dollars saying we will repurchase our shares because that will keep our stock from falling as much as this stock over here who's not doing it. That's the idea. I mean, Apple buys probably more stock buyback than anybody, I think. And so that's why you see that. You got, like I said, you got companies that announce taking on debt just to have these stock buyback programs in the billions, right? I mean, 10, 15 billion for one or two companies. That's a lot. That's a lot of shares. Okay, and so again, that's where we're at, or just to have it in their back pocket in case things do get bad. And so that's what I've been saying. These stock run-ups and we're going into a new bull market. I'm like, how are we going into a new bull market? We got to figure out where we're even at, what the contraction needs to be. All right, and to answer that question, which nobody knows, that's just the way. That's why people are having so much trouble with the fundamentals, trying to figure out what do you actually value this stock at? Because, like they said, you have an 18, multiple on something, on the S&P, for example, that's in good times. 18 to 20 is in good times when you're getting free money, right? We're not getting free money anymore. It's expensive money. These companies to take on debt now, right? It's expensive for us. Inflation on top of that, on top of all the interest rate hikes and the balance sheet roll-off, if that ever starts to happen, makes it even more expensive for us to get stuff, right? And so all this liquidity should be coming out. Well, what's the multiple need to be? Right? They need to be 15, 16, 17, right? And that's what the hedge funds are looking at, all the big boys, all the millionaires and billionaires. But the truth is, nobody really knows because we've never been through this before. So we're all just kind of figured out, writing each chapter. I told you every month's a new chapter, right? And so that's where we're at. And, you know, I'm glad he said what he said. We'll see. The market obviously did not take it well today. They said, how about that? So the big rug pull happened. Shocker there. Monday will be an interesting day. Next week will be interesting because, remember, there's really nothing going on until we get the new CPI read next month and they decide to raise rates next month. And so you know how the market is. You know, it's kind of like a drunken frat boy. If they know they can get away with stuff and have fun, they're going to do it while they can do it, even if it makes no sense. And so that's why you get to see. Some people are betting a bounce back next week until we get up, you know, to them doing the CPI release and then the Fed funds rate increase, which is going to be whether it's 50 or 75. And that's another thing. What the heck is 25 basis points? Let's be real. I mean, everybody's like, it's 50, we should go bullish. I'd be like, or it's 75, who cares? It's 25 basis points. That's what we're talking about. That's it. What happens if they do 25 or 50 next month? I don't care about that. I'm talking about what's the final number. That's what I'm looking at. What's the final number? How long are you holding it for? That's key. How fast is inflation coming down? I get so tired of these debates about is it 50 or 75. I'm like, what's 25 basis points amongst friends? I mean, come on, really? Seriously? And so, you know, that stuff is getting over dramatized at this point in time. Because guess what? They already told you what they want to get to. And they want to. The key point is holding it as long as they can. Try to get inflation down. That's the key. Want to get demand down. How you get demand down? Take money out of your pocket and my pocket. That's what they want to do. Okay? That's the way. That's the goal. We'll see how it works. We'll see how the stock market digests that. Should we be going all-time new all-time new highs? Absolutely not. I've said that multiple times. Absolutely not. Because if we do, man, the fourth quarter 2023 is going to be looking really rough. Real rough. Because the Fed is not going to be happy campers at all. Remember, once that election is over, I think you could see a pit bull being released off the leash. Because at that point in time, who cares? You already reelected who you're going to reelect, right? Or elected who you're going to elect. So, you know, interesting times. Monday will be interesting. Let me know in the comments. You think it's going to be a bounce back day? Because usually when you get sell-offs like this and the Nasdaq's down 4% in one day, you know, you usually get some kind of bounce back. But the question is, will we continue to fall? You think we'll continue to go down to the 50 moving average on the SPY? That's what I'm curious about. So anyway, hope you guys have a good weekend, and I'll see you later.